Hey, welcome to Accelerated Wealth with Chris Abeyta, your host and co-host Doug Berkey, where you get retirement confidence in an uncertain world. Today we're talking about the energy industry because it's been going up and it's been going down. The question is it time to buy and get back into the energy industry? You know, in just a moment, we're going to talk with consultant and the founder of Global Focus Capital. His name is Eric Weigel. He's going to explain what metrics he uses to tell if it's a good time to get back into the energy industry or to get out. He'll tell us what you should keep an eye out for, and he'll divulge some industries that have better short-term and long-term investment potential. You know, it's interesting to watch different industries or different sectors of the economy, Doug, that go up and go down, and that's one of the things that we do in our managed account. Very interesting. Last week, we received a trigger in our managed account that said there's a very high probability of a short-term drop in the markets. And so we triggered, our accounts moved into a hedged position. All of our clients that are in that managed account received a text message letting them know that they're in that. And I know that for a fact we've been out of energy for months now because of the drop and missed that big drop. The question is it time to get back in? So looking forward to talking with Eric. Eric is a financial speaker. He's an author. He's also a consultant, and he's the founder of Global Focus Capital. He began his career early on in the Federal Reserve with the Economic Research Department there in the Federal Reserve, and that's interesting. It'll be interesting to hear about that. He headed up a variety of senior portfolio and research efforts for Pioneer, MFS, Hermes, Invesco. He was also recently a senior portfolio manager and director of research with Leuthold Whedon Capital Management. He's been published in the Journal of Portfolio Management, Financial Analyst Journal, the Journal of Investing. I mean, it's an all-star approach here. He's also been featured on Yahoo Finance, the Wall Street Journal, Kiplinger, and many TV programs. Eric, it's great to have you. Thanks for joining us today.
Thanks for having me, Chris and Doug. Looking forward to it.
Man, how did you get involved in, I mean, you got a huge money background from an early age. How did you initially get involved?
Well, I started my career as an economist, and that's when I worked at the first. My academic training up to that point was really economics, and then I was looking for ways to become a little bit more hands-on in my analysis, and that's when I found finance. And basically, I look at finance as an extension of economics, but where you can measure your actions over a much shorter time interval.
Well, interesting. Someone might be looking at the low price of energy stocks right now and see an opportunity. Do you disagree? And if so, why?
No, I think I disagree in the sense of making an overall big sector bet on energy stocks. I think that within the energy sector, there are plenty of stock selection opportunities, but I would do it much more from a low-risk perspective, either in a long-short way or in a hedged way. So, because one of the things that has really surprised the market in the last year or so has been this massive drop in oil prices. And when you look at the prior 5 years, for example, you know, there was a very tight trading range for oil. And that all changed starting in the summer of last year. About a year ago, it started changing. And initially, you know, the typical the reaction of investors, which was, you know, fairly rational, was to sort of buy in the dip. But by the fall, you could actually tell that something had fundamentally changed in the oil market. Right now, you stand at 30-40% below sort of the normalized price of oil over the last 5 years.
What caused that? I mean, you know, as consumers and people listening right now, we drive, we go fill up our gas tank, and we don't feel like we have any control over gas prices. It's always somewhat dictated to us. And, you know, as Americans, we don't really slow down our driving if gas prices go up, and we're glad when they go down. You know, we go through these ups and downs. What did you see causing this major drop in oil and drop in gas prices recently?
Well, frankly, I think it took everybody by surprise. I mean, there are always people predicting, you know, lower prices or higher prices, and they get it right. But the vast majority of the market, the consensus was for oil prices to remain fairly steady going back a year ago, especially given the backdrop of an economic recovery. I think what happened was that the tremendous increase in supply of oil finally caught up with us. And when I say us, I really mean the world. on top of that, the Saudis and OPEC countries have been pumping oil like crazy. There's the emergence or the re-entry of Iran into the official oil market, which has also changed sort of the psychology of that market. And I think on top of that, you also have a fairly decent economic activity, but the conservation efforts that everybody has been making globally has resulted in less demand for oil. So I think you've had that classical supply-demand imbalance. But to be honest with you, it did take a lot of us by surprise.
That's interesting how, something that is so controlled and we all depend on can really surprise everybody so dramatically like that. If you just joined us, you're listening to Eric Weigel. He's a consultant and founder of Global Focus Capital. We're talking about energy prices and why oil has dropped so much, and is oil going to be bottoming out here? And then when we come at the bottom of the hour, we're going to talk about some of the major dangers that we're seeing in the economy. You're going to want to stick around because those dangers are going to have possibly a direct impact on you and your retirement.
Eric, I saw a quote that the former president of Shell Oil, John Hofmeister, predicted that crude oil prices would hit $80 to $90 a barrel later this year, and that gasoline prices would reach $5 a gallon by the end of this decade. How does that impact your outlook on this particular industry?
Well, if his predictions are correct, I would say that it would go back to being a normal or a normal hold, not a raging opportunity. Given the fact that oil has been around $80 to $100 a barrel for the last decade or so, so I think I don't see a recovery happening that quickly. I think there's a tremendous supply out there. I think as I mentioned, in the broadcast, the Iranians are coming onto the market. And there's a lot of production has been taken offline already.
Sure.
And that can come back very, very quickly. You get prices $80 a barrel, I guarantee you that a lot of production will come on very, very quickly.
Okay.
It's interesting. I'm curious for your take, Eric. Some people have speculated that the Saudis continuing to pump in an environment with a glut of oil on the market was intentionally done to try to crush the U.S. fracking industry because their margins are not nearly as high as, say, oil being pumped in Saudi Arabia. And I do know that a lot of wells have been taken offline, a lot of rigs not in use right now in that fracking industry. What's your take on that?
No, I think that's spot on. I think the Saudis have been pretty clear. Maybe they haven't explicitly said that they're trying to destroy the U.S. fracking industry, but let's face it, I think
I don't need to say
the less reliance we have on Mideastern oil, the less important Saudi Arabia becomes for us. So I think the gap in production costs is so dramatic that the Saudis will always have that ability to decide, basically what the price of oil will be in the global markets.
Now, this might be a different question for you, Eric, but one of the things that we're seeing in the economy is, even though we're dealing with much lower gas prices, that means the average American is paying much less. There's more money in their pocket. We're seeing the GDP coming to a screeching halt. It was 0.2% for the last quarter, which is nothing. And who knows, that might get revised and it might even go negative. People aren't spending that extra money. Why do you think that is? What are you seeing in the economy?
Well, I think people are naturally cautious. People are still thinking about the financial crisis.
But we're 7 years out. We're 7 years away from when that happened.
Oh, absolutely. No, absolutely. I think, but it was such a dramatic event that I think people are still thinking about that in terms of their portfolios, but also, very importantly, in terms of the labor market. So the official labor market statistics seem to point to very healthy market. The reality is that there's still a large number of people unemployed. Yeah. They're just not counted in official statistics.
Exactly.
And the uncertainty in sort of the jobs, your job situation is still there. So I think that's one of the reasons why people haven't been as aggressive in terms of their spending.
I agree with you. There are a lot of dangers on the horizon. We're going to talk about that in this bottom of the hour when we come back. When we come back, we're going to talk a little bit more about the energy industry. Could it be bottoming out? When is the time maybe to get back in? You're listening to Accelerated Wealth with Chris Abeyta and Doug Berkey. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back to Accelerated Wealth. This is Chris Abeyta with your co-host Doug Berkey, and today we are interviewing Eric Weigel. He's the consultant and founder of Global Focus Capital, and we're talking about energy prices. And Eric, when we were over on the break, we were talking about the blessing that the fracking industry has been here to the United States, really on private lands, but not on public lands. The administration has not allowed us to actually explore more on public lands. There's actually been less exploration and less oil coming out of public lands. But in the midst of all this, we're seeing energy prices, they're dropped. They're 30, 40% down from where they were. What triggers do you look at? What metrics do you look at to say, is this bottoming out? Is it time that maybe we're going to begin to see a rise? Is it time for investors to get back into oil, or should they continue to be cautious?
First of all, I look at energy stocks or the energy sector. We apply fairly quantitative criteria to looking at comparing all sectors across each other. And things that we look at are, for example, valuation, growth, potential, profitability, the yields, and then finally the sentiment on the sector. So we rank all of these industries and sectors across each other, and by that metric, the energy stocks have been improving slightly, but they still rank, pretty much in the bottom third of the sectors that we're looking at, as compared to maybe going back 6 to 8 weeks ago, which they ranked at the very bottom.
Okay.
So I think there's been some improvement in the fundamentals of the sector.
So that horse is not last place anymore, but it's nowhere near the front three. It's not in the trifecta.
Correct.
Yeah.
Correct.
So,
and it's still it would still sort of translate in a portfolio into an underweight.
Okay, so we're seeing momentum, but nothing compared to other things out there that would make you say now's the time to get back in.
Right. My criteria was really to look at valuation. When valuation got low enough, that was my trigger for saying, okay, this is the time to go in. But what actually happened is, and this is the way capital markets work, people anticipated that there were some very smart people talking about, okay, this is the time to go into energy stocks. From my perspective, it was too early.
Yeah.
But what's happened is that the valuations, while they've compressed from a year ago, they haven't compressed enough, in my opinion.
Okay.
So, Eric, where do you see this bottoming out at if this isn't the sector to be in right now?
I think this sector will just sit in a lower ranked position, not offering investors much return for a long time. And I say that simply because I think there's a tremendous supply of energy out there, alternative sources of energy as well. And I just, don't see the valuations. I think there's too much overcapacity in this sector. Similar to, for example, the tech industry in the late 90s, there are just too many companies out there. So I would imagine that one way to make money in this sector is trying to anticipate M&A activity. But as a group, as a whole sector, I just think that this sector, we've seen the best days of the commodity cycle behind us, and we have a fairly lengthy period of sort of retrenchment, and that's my expectation for the sector.
I think we're seeing that globally, where we're seeing a lot of not inflationary pressures, but deflationary pressures. China's economy has been slowing down, even though they're still cranking out a nice GDP. It's been going down, which means their demand is lower. So it seems like maybe there's a combination of oversupply, like we talked about earlier, but it also seems like maybe there's also a slowing demand. Would you agree with that?
Absolutely. I think, I don't necessarily want to use the term the new normal. I do think that economic growth globally is several points below where it's been historically, and it will remain so, primarily because of the overcapacity and the nervousness of people generally across the globe.
So definitely not a sector to be in right now. If you just joined us today, we're talking to Eric Weigel. He is the consultant and really the founder of Global Focus Capital. It focuses on energy, and we're talking about, hey, is it time to get back into energy stocks? Is it time to reinvest? And really the bottom line is not yet. Not yet. We're probably going to bounce around sideways here for a while. There's not a lot of momentum. We have a slowing demand globally. We have an oversupply of oil that's beginning to shut down and come into not much of a glut of an oversupply, but prices seem to be stabilizing. I'm seeing my gas go up a little bit here and there. It seems like it jumps 10 cents a week, but I like seeing under $3 gas for sure. Eric, any other things for our listeners that they should know when it comes to maybe just your outlook on the economy or your outlook on energy?
Well, I think in general, I would favor growthier segments of the capital market.
Yeah.
I think economic growth is fine. It's not what it used to be, but we've adjusted little by little. And I would focus more on growthier sectors like healthcare, healthcare and technology.
Yeah, we're heavy in healthcare.
Even consumer discretionary, for with these low interest rates and sort of the bonus the low gas prices provide, I think the consumer discretionary sector, has fairly good, prospects.
You bet.
So
there's better sectors out there right now, and one of the things, Eric, you may not realize is we have a managed account that we watch very closely, and it is I would say momentum driven. So we are watching triggers and momentum, and at any point in time, we're probably in the top 5 to 6 sectors in the economy that have the highest producing momentum. We got out of energy way last summer, haven't been in it, but things that have been hot have been things like healthcare. Utilities was up for a while, and that kind of started. Real estate dropped off. Yeah. So those are the kind of things that we're watching. And if that's something you're interested in, you're listening right now and thinking, wow, I wish somebody was watching my money, and I don't know where to be, when to be there. I can't time it. Maybe you have a full-time job, of course, and you don't have time to know how to watch this thing. That's something that we do offer, which is a managed account strategy that is putting you into the sectors that have the most momentum and also watching triggers for when the market might go down into a crash. And as I mentioned last week, our investors all got a text message saying there's a very high probability of a short-term drop in the market. We still are seeing long-term growth, but short-term drop. And they got a text message saying that they've been moved into a hedged in a position of safety. If that's something you're interested in and you don't have in your portfolio, give us a call. The number is 466-5634. That's 466-5634. We can sit down and see if that might be a fit for you. Eric's been great having you. Thank you for sharing with what's going on and your perspective with oil. It's nice to hear from somebody that really knows this, that maybe it's not time to get in. You might have really saved some people some time, some heartache, some money, and continue to watch it in the future.
Thank you very much, Chris and Doug, for having me on your show.
Oh, you bet. Thanks for joining us today. We appreciate it. And
thank you.
Your website, real quick, for people to get more information from you is www.gf-cap. So www.gf-cap.com, right?
Correct.
Great.
Yes.
And that's if you want to get a hold of Eric Weigel, founder of Global Focus Capital. Eric, thanks so much for joining us today.
Thank you, guys.
Good to find out that energy may not be the place to be right now. Certainly we knew that. But, Doug, let's transition for the rest part of our show. I want to talk about the dangers on the horizon that we're seeing. And there's global dangers, there's national dangers, but really what it comes down to, there are personal dangers that are going to affect you if you're not protected from them. And here's what I mean by that. This is what Doug and I are seeing that you need to be aware of. And we're going to cover some of the landscape of things that we're seeing here. So the question that I have for you right now is, if there was a missing fact or a missing piece of information that you didn't have, and it was going to cost you a lot of money, whether that's now or in the future, when would you want to find out about that? Would you want to find out about that now? Would you want to find out about that in 5 years or 10 years? And really what we're asking is, if something was truly in your best interest, wouldn't you want to know about it right now? And of course you would. Of course you would. And so here's what Doug and I are seeing. We're going to share some things that are critical pieces of information for your decision making going forward with your current retirement strategy, your current investments, where your money is, what your future looks like. And we want to bring some of these critical pieces of information to the forefront so that you know about them. And some of these things are things that could impact you in the future. Some of these things are things that are actually happening right now inside your portfolio or in your investment accounts that you're not even aware of. And we're going to cover these. And I want you to take some notes. I want you to listen because they may be happening to you right now, and they may have a huge impact on your financial future. Doug, the first one, and we're going to touch base on this, and then we're going to come right back into it because we're going to go to break here in just a few seconds. But HSBC, the chief economist, Stephen King, no, not the author. That's so scary, but this is scary. He is the chief economist for HSBC, and basically he warned this week, the world economy is like an ocean liner without lifeboats. If another recession hits, it could be a truly titanic struggle for the economy around the world. We're going to come back. We're going to talk about this. Don't miss this. We're going to talk about the dangers on the horizon that you need to be aware of to make sure you're not losing or seeing a lot of money fall through the cracks. You're on Accelerated Wealth with Chris Abeyta and Doug Berkey. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back to Accelerated Wealth with Chris Abeyta and Doug Berkey. We are talking about the dangers on the horizon. And, you know, when I look around, Doug, and you think about the stock market has been on a tear going up for 2,200 days. It is the third longest bull market in history, which makes me scratch my head going, because we know why this is happening. So the third largest bull market in history. So here's the question. When is this party going to end? And we're going to talk about some of those things today. And when is it going to come crashing down? And the question for you is, how much can you afford to lose in the next market crash? So what you need to do is you need to take a look at, is it time to really protect yourself? I believe it is. It feels a little bit like 2007. The markets are pushing all-time highs. Things are up. It's time to protect yourself now with our 5-point master plan. And this is what we do for our clients. And when you come in and sit down, here's what we do with our 5-point master plan. Number one, we're going to show you concrete steps of how to protect your entire life savings. If you've been saving for 25 years, maybe 30 years, it's time to get some protection for the next major market crash. You do not want to go into another 2008 or another 2001 where you lose 30 or 40% of your entire life savings. You're 7 years closer to retirement than the last time the market crashed. We can't have that happen. So we're going to show you concrete steps to protect your retirement, your life savings. You'll also discover how to build a rock-solid retirement plan no matter what happens within the stock market, how you can legally pay fewer taxes in retirement, and why so many retirement plans are failing today and are riddled with costly mistakes. So if that's interesting to you and you want to get your free customized 5-point retirement master plan, be one of the first 10 callers, and you can reach us here at 466-5634. That's 466-5634, and we'll go through and show you that 5-point master plan on how to secure your retirement. Now, Doug, we're talking about the disasters or the dangers on the horizon, and we finished the last segment here with the chief economist. His name's Stephen King for HSBC, and he's already thinking about the next recession. And this just came out last week, and he said the world economy is like an ocean liner without lifeboats. Usually you're on a cruise, you got lots of lifeboats, you do the whole thing, you get your life jacket on. Well, we don't have any more lifeboats. What does he mean by that?
Well, he's really talking about the fact that the Federal Reserve and the central banks of the world have very few tools left in their bag of tricks to help if and when the next market correction hits, because normally what they would do, Chris, is they would lower interest rates. Well, interest rates really can't go much lower than what they already are. That's one major tool.
This is important. We're 7 years away from the financial crisis. 7 years. Interest rates have not gone up. There's nothing normal. There is nothing healthy about that. So if or when we go into another crash, the Federal Reserve does not have that tool, like you said, to be able to say, okay, we're going to make everything liquid. We're going to lower interest rates. We're going to make money available to fix the economy. They don't have that. They can't pull that out of their back pocket.
Well, and then the other major factor, Chris, is because of all the money printing with the quantitative easing 1, 2, and 3, and then what was referred to as the twist, where they used some other manipulative strategies to print more money, because the Federal Reserve has bought about $4 trillion worth of treasuries over the last few years, their balance sheet is almost non-existent. So they don't have the money to step into the market and buy any more treasuries.
Unless they just keep printing it, which,
well,
how much?
Yeah, how much can you print? So, it's really, they're backed into a corner. Yeah. They have very few choices right now.
This is important because we've never been here, ever, in the history. And part of this is it's important for you to recognize, as the stock market has been on a tear, going up for 2,200 days, pushing all-time highs. Of course, the NASDAQ is just now breaking even from where it was 15 years ago. We could be at the precipice, I don't know when, but things are fragile. And even this chief economist from HSBC is saying it's very, very fragile. Some of the things he's concerned about that could trigger the next recession or the next drop would be wage growth. So as wages continue to go up, or if that's implemented from a policy decision, that can hurt profits in the company. If that hurts profits in a company, that drops the market. If the market then begins to drop, then people begin to lose confidence in the market and they start selling off, and that could be the trigger that starts a massive sell-off. There's other things out there that he's concerned about as well, non-financial systems such as pension funds. So if we see this happen again and pension funds lose tremendous value like they did in 2008, they could not have the money to pay people's pensions. I mean, look at Chicago, just downgraded last week to junk bonds. Junk. And then again, look at Greece.
Yeah, Greece just recently managed to make a bond payment to the European Union, but it required them, Chris, to take out money out of their pension plans for their retired workers. Wow. And to not pay their current government employees. And they have 4 huge bond payments coming up between now and the end of the summer that make the current payment they made pale in comparison, 4 times larger, 4 different times. So when Greece fails, unless major concessions are made, that's going to have ripple effects throughout the economy, both for the European common market and for us here in the United States.
That will, and if you remember, when something happens overseas that's big, it happens here immediately, within seconds, and that shows up in your 401k, it shows up in your IRA. So if you're not protected, and this is what we were talking about, I mentioned this earlier in the show, if there was a piece of information that was absolutely critical to you, and if you didn't know this, it's going to cost you a lot of money either now or potentially in the future, maybe while you're retired, maybe 5-10 years from now. Wouldn't you want to know what that is? And so what we're doing is we're trying to recognize some of the major dangers that we're seeing on the horizon. And really this comes back to protection. Are you protected? Are your accounts protected, or are you missing protection? And this is one of the biggest things, Doug, that we see is that when households, couples, individuals, just like you listening right now, come in and visit us, probably, Doug, one of the biggest things we see is that people are overexposed to risk. It's unbelievable.
Yeah. And what's interesting, Chris, is at our workshops that we do, when you ask people what percentage of their portfolio are they willing to lose, almost invariably they say, well, none. Mm-hmm. And yet when you ask them where their money is at, it's all in the market. We've been taught not to have all of our eggs in one basket, and yet that's the basket that the vast majority of Americans have their money in. And you're right, they're absolutely exposed to way too much risk.
And, it's easy to get that warm and fuzzy feeling because the last 5 years the market has really churned up. I mean, it's just gone up, and that's a good thing, because if you have been exposed, you might have really gotten lucky, and hopefully your accounts have recovered. They're back. Maybe they're higher than they've ever been if you've been continuing to add money to those accounts. So now is the time to really be thinking about protection. And if you don't know that you are protected, here's a question. If we go through another stock market crash like we did in 2007 or 2008 and 2000, are you going to lose another 30 or 40%? Have you done anything different to protect yourself? And if you have not, you need to give us a call. The number's 466-5634. We need to sit down and show you our 5-point master plan that's going to show you how to protect your accounts, how to build your retirement, how to show you what your income can be, and how to even minimize your taxes there. give us a call, 466-5634. That's 466-5634. Doug, let's talk about this being overexposed. The majority of things that we see are that people are overexposed because they have so many mutual funds in their accounts, in their IRAs, their 401ks.
Yeah, absolutely. That comprises a huge portion. And some people have gone to the idea of a target date fund. I saw a recent report that indicated that by the end of the decade, that'll represent about 50% of money invested in 401ks. And the problem with that is if you're close to retirement, you're going to have a preponderance of your portfolio moving from stocks into bonds, which used to be the safe haven. But in today's interest rate environment, bonds are not a great place to be, because when interest rates do go up, your bonds tend to go down in value. So you have, just at the time in your life when you want to be safe, you're being told by the typical model to move into a product that's almost guaranteed to go down in value, because when interest rates go up, bonds go down in value.
It's a fallacy. And so this is one of those critical things. Maybe this is happening to you. Maybe you've talked to your broker or your advisor and said, I want to be more conservative. And they said, okay. And they moved you from more equity funds or stock-based mutual funds into more income-based or bond-type mutual funds. And that used to be the safe way to go, but it's not anymore. This is a major alarm that you need to realize. This is critical, because if interest rates go up, or when they go up, those bonds are going to lose value, and your mutual funds that are invested in bonds are going to lose value. If that is happening to you, give us a call. We'll do a free portfolio review for you and help you identify where are the critical pieces that you are missing, where money could be falling through the cracks or just about to break out. So give us a call. We're going to come right back. We're going to talk more about the dangers that we see on the horizon that are critical pieces of information for you in your investment decision making. The number is 466-5634. That's 466-5634. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back to Accelerated Wealth. This is Chris Abeyta and Doug Berkey on Accelerated Wealth, where you get retirement confidence in an uncertain world. And we are talking today about the dangers that we're seeing on the horizon. And we just finished talking about the chief economist, Stephen King from HSBC, some of the major dangers he sees as a coming recession or a potential major drop, and how that's going to impact the economy, but how's that going to impact you personally? And then we just started talking about mutual funds. And as I'm talking to you today, the major danger that I see for people coming into our office, maybe listeners just like you, is you've been saving in your IRAs, been saving in your 401ks, in your investment accounts, and they're loaded with mutual funds. And we're so close to all-time market highs. There's this feeling in the air that could this next stock market crash be around the corner? Could it be this fall? Could it be this summer? I don't know. But the key is we see people that are so overexposed to risk. And when we ask people, how much money are you willing to lose? The usual response is, well, I don't want to lose any. And yet when we look at how your advisor or how you have your money positioned primarily in stocks, bonds, and the big one is mutual funds, it's amazing that there's such an incongruence between the protection that you want or the amount of risk you don't want to take and the amount of risk you actually are taking that you may not even be aware of. And that requires action. And we're going to break down a little bit about the challenge that we see with so many people today with mutual funds. And here's what you need to know. You need to know that risk can be controlled. Market risk can be eliminated from your portfolio, and it can be managed, and you can actually get market-like or market-based returns at a fraction of the risk that you're taking right now in mutual funds. In fact, you can probably get even better returns based on historicals that we've seen in our managed account that has done very, very well. It's outperformed over the last 14 years or so the market with about a quarter of the risk and the volatility. And so there are ways to control risk, and that's what we do for our clients. And if that's something that's interesting to you and you're wondering, how do I protect my retirement? How do I get concrete steps that can actually protect it? How do I make money when the market's going down? Is that possible? And it is. There are ways to change things in your retirement. So if that's interesting to you and you feel like, you know what, I know I've got too much risk. I know I've got too much mutual funds. I just haven't taken the time to do anything. Now is the time to take action, especially before you go away for the summer, because typically what brokers have said is sell in May and go away because the summer gets really volatile. So before that volatility of the summer kicks in, you want to do something and take action. Give us a call, 466-5634. That's 466-5634. Now, let's talk about the mutual funds, Doug. First off, what's really interesting is the mutual fund was a financial tool that was designed primarily for people to accumulate money in. It really took off back in the 80s when the 401k became standard for a lot of companies. Companies moved away from a pension, so they moved away from providing you income for the rest of your life and they said, why don't you just, instead of us being responsible to give you a paycheck for the rest of your life, we'll just contribute some money into your 401k and you manage it and you can put it into investments in stock market and things like that. And you manage it and someday you'll have enough, hopefully, to manage your own retirement. So Wall Street came up with all these mutual funds. And at one point and I think there still are more mutual funds than actual stocks.
Yes.
So they came up with this saying, this is a great way to grab people's money. And it was designed for the baby boomer generation back in the 80s when the boomer generation was young. And they could afford to lose some money and had plenty of time and time horizon to make it up. Well, things have changed. The baby boomer generation is no longer in that accumulation phase. You are in what we call the retirement hazard zone. You're either retired, very close to retiring, and you're getting ready to the point where you're going to need all the money that you have to be able to retire peacefully and safely. The problem is you're still using a financial instrument that was designed to help you save money and grow money, not designed for two things, not designed to protect your money and certainly not designed to create an income with your money.
Yeah, no doubt. And what I think people miss, Chris, is that, everybody sees the market at these all-time highs, and yes, we've bounced back very nicely from that last crash. But if you look at the actual rate of return over the last 15 years in the market, it's less than 3%. At 3%? And with the risk you're taking to get 3%?
People don't realize that. But if you look at the S&P, you go back to the S&P, it was around 1,500 in the year 2000. Now it's around 2,050, somewhere around there. If you do the math and divide it out per year, the S&P has actually gone up about 2.5% every year. That's nothing.
Yeah.
How many of you have been told that your financial advisor said, on the long term, the stock market, it'll do 8 to 11%? Well, yeah, maybe if you include the last 50 years or 100 years, but certainly not the last 15. And we're in a new era.
Well, and I think the other thing that people miss, Chris, is there's a huge headwind in your 401k portfolio, in your mutual funds, because of all the fees that are hidden in there. And we've seen some recent articles that have actually laid out what some of those fees are. What does that look like in terms of total cost?
Here's what it looks like. And if you're joining us just right now, this is Accelerated Wealth. We're talking about the dangers on the horizon. And one of the biggest dangers that we are seeing on a regular basis when individuals and couples come and sit and talk with us is you're taking way too much risk for this season of your life. Way too much risk, and you're not controlling it. So we're talking about mutual funds. And Doug, here's the cost of a mutual fund. The Morningstar said that the average cost expense fee of a mutual fund is about 1.2%. Sounds reasonable, Mm-hmm. But then what they don't show, and this is an article that just came out. If you want to give us a call, I'll be happy to give the article to you. But inside that mutual fund, there's additional costs that you don't see. There's trading costs, and this is when the mutual fund manager is buying and selling stocks and bonds inside that mutual fund. That averages around 1.2%. Then, typically, a mutual fund will have about 10% of what's invested in cash. And the reason they do that is they might need to liquidate. If people sell the mutual fund, they have to send money back. Or if they're looking for companies to buy, they have to hold on to that cash for an opportunity. So if 10% is in cash, that means only 90% of your money is actually invested. So they estimate that cash drag to be about a 0.8%. And then if you're being managed by a brokerage house or Wells Fargo or whatever, you might have an advisory fee of 1%. So if you add all those up, you get an estimated 3.5% cost for your mutual fund. And if the S&P has only done 2.6 or 2.5%, no wonder 80% of mutual funds fall below the S&P. They do not outperform it. So
let me see if I get this straight. I'm paying for professional management, and yet about 98% of fund managers don't outperform just buying the S&P 500 alone and holding it.
Exactly.
Which I can do for almost free.
You can do for almost free. Now, so that's been a major move into the index fund. Just buy the SPDR index for the S&P 500. That is, of course, it's done fantastic the last 7 years. Fantastic. So if you've been in that, great. It's been low cost and you've made a ton. The problem is, back in 2000 to 2002, the S&P lost 47%. And then in 2008, it went down from 2007 to 2009, it went down 57%. So these tools, mutual funds, they work on the upside. They're designed to throw money into, diversify on the upside because you don't know what's going to grow more than something else. But here's where they fail. Number one, fees. They're very expensive. Expensive to hold. There's all kinds of tax inefficiencies. But here's where they fail. Number one, they are not designed for a market crash. And you remember this. You know, when the market crashed, your mutual funds, they all went down. There is no downside protection on a mutual fund portfolio. So that's number one. Number two, they are not designed to be an income tool. You cannot effectively take income out of a mutual fund and know that you're never going to run out of money in retirement. Ever. It'll fail. It is a failed tool. The mutual fund has never brought a generation safely through retirement. Remember, the last generation had pensions. This generation, we've got mutual funds, and it's still an experiment that has failed miserably in some cases. If you think, what was that T. Rowe Price study?
Yeah, T. Rowe Price said that if you try to take out 4% out of your retirement portfolio and then adjust for inflation, statistically, you have a 71% chance of running out of money over a 3-decade period of time.
71.
So T. Rowe Price, one of the biggest mutual funds, is telling you that's not the way to go with too much of your portfolio.
This is so important. And then Putnam, a huge mutual fund company like T. Rowe Price, they did a study in 2011 after this market crash and everything, and they said how much stocks or how much mutual fund holdings that are volatile, they go up and down, should somebody getting close to retirement or somebody in retirement actually hold. And it was shocking. This is a mutual fund company doing the study. They came back and said, you should have no more than 10% of the money you're going to rely on in retirement in the stock market or in a mutual fund. No more than 10. And they stretched it and said, well, maybe up to 25%. But Doug, what we're seeing on a regular basis is people have 90% of their entire life savings in the market. And that is one of the critical factors that you need to be thinking of. Are you overburdened in expenses? Are you relying on the wrong type of tool? Are you relying on a screwdriver to try and turn a nut or a pair of pliers to turn a nut and you're just going to just strip that nut? When you're relying on mutual funds to protect you in a down market and you're relying on them to give you income that you will never outlive, it's impossible. If that's you and that's happening to you, give us a call. We'll help you fix it. We'll walk you through our 5-point system that will help you protect your money, help you create a retirement that you can't outlive, and give you the security and peace that you're looking for and that you deserve. The number's 466-5634. That's 466-5634. Call us now. We'll show you how much risk you have, and we'll get you into a much better place that you're going to feel great about. 466-5634.
The opinions on this radio talk show are those of Mr. Abeyta and Mr. Walton and their guest speakers, not necessarily those of Accelerated Wealth, LLC. The radio talk show may contain forward-looking statements, including but not limited to statements as to future events that involve various risks and uncertainties. Forward-looking statements involve known and unknown risks, uncertainties, and other factors that may cause actual events or results to differ materially than those that were forecast. Therefore, no forecast should be construed as a guarantee. Investing in security and annuities involves a risk of principal loss. Prior to making any investment decision, a listener should consult a professional to determine the risk, benefits, fees associated with a particular investment. Info obtained by a third-party resource is considered reliable, but accuracy cannot be guaranteed.